Yeah, started.
Leave the door open because at least one breadcrumb.
And we talk about dividend theory policies. Yeah, there are two big theories that always come up in your exam. One is this dividend policy theory, and the other one is the capital structure theories, which I've talked about. This you all must know before you go for the exam. Yeah. So what is the story behind dividend policy? Why is dividend policy so important? Because dividend policy is a financing theory. How much dividend a listed company pays will have a direct impact on how much profits it has available for reinvestment. Yeah, that's what it is all about. So theoretically, how much dividend a company pays has no impact on share price. Again, the same two mathematical geniuses, Modigliani and Miller, they provided mathematical evidence to show that if you talk about valuation methodology, in valuation methodology, it is the present value of dividends that should determine share price, not the pattern of payment. You see, uh, we mentioned this earlier. Overall shareholder value of a firm based on future cash flows works like this. Shareholder value is equal to cash flow per annum divided by required return. And this one, when you use this formula, it returns what we call the present value of future cash flows. Yeah. So this is actually the same as present value of future cash flows. That's what it is for the whole company. If you want to work out the value of a share, based on a non-controlling interest, that means I just have few percent left. Then the only thing I can look forward to is what? Dividend, right? So value of a share based on non-controlling interest is also equal to, therefore, present value uh, of future dividends. How do we work out value? Value is equal to next year's dividend. Let's put it here itself. Next year's dividend divided by required return. Only thing here we have minus expected dividend growth rate. Growth rate per annum. If this gives you a bit of deja vu, well, don't be surprised. because this formula is the mother formula from which we derived our cost of capital formula. Our KE formula is actually derived from here. Yeah, let me put some numbers to show you how this will work. Yeah, let's say example. Mm, shall we make this blue? Let us say next year's dividend equals RM 250. Current share price equal RM 2820, and expected growth rate of dividends, expected G, I put, you all know what that means, of course, is equal to 3.48%. Very exotic number. Then I can put earnings yield of similar companies, or sorry, dividend yield. Yeah, average dividend yield of similar companies, or sometimes we put sector, yeah, from the sector, is equal to say 12%. Yeah, 12%. Now, so the value of the share will be value of the share based on this formula will be next year's dividend, that is 250. Yeah, when, well, I don't need brackets really on top, but for good measure, divided by 12% minus 3.48%. So I'll get equals, yeah. So here I will get 2.5 divided by, in bracket, 0.12 minus 0.0348. That will give me 29, 34, 27. Yeah. So now my question to you is this: will you buy this share? Yes or no? Come, people, talk to me. Will you buy this share? The current share price is 28.20. When you calculated the value based on your present value of future dividends, you got 29.34. So will you buy this share based on your maths?
Yes.
Yes, you would.
Yes.
Yeah.
Yes.
Because uh, according to your calculation, according to your maths, the value of the share should be 29.34, isn't it? But
Yeah.
now it's 28.20, so yes, it will be buy. Yeah. So buy this share. Yeah. There you go. That's how it works. Okay. So Modigliani and Miller did this calculation. They said, look, when we do this valuation, What we are doing is we are taking future cash flows and bringing them to their present value. The value of the share is simply the present value of future dividends. Does it matter whether I pay high dividends now and less dividends later, or I pay a very constant dividend, or I don't pay dividends for many years and then I pay one huge dividend after a few years? As long as the present value of my future dividends is going to be 29.34, then that's the value of the share. Yeah, as long as the value of the uh, dividends, the present value of dividends is 29.34, that will be the value of the share. And if that's the value of the share, then that will be the value of the firm. So according to them, it is the present value of dividends that determines the value of the firm, not the dividend policy, not the timing of dividends. So they said dividend policy has no impact on share price and no impact on value. Yeah, that's basically their conclusion. Um, so, uh, dividend policy, of course, what does it mean? Well, dividend policy means how the company has planned to pay out dividends out of their profits each year. Some companies have got this policy that we want to tell the market, look, our profits may go up, may go down, but we will pay you a constant dividend. Some shareholders like that. Then, when we follow that kind of dividend policy, we will attract that sort of people. Yeah, that is called the clientele effect, by the way. Clientele effect. Even Modigliani and Miller acknowledge the clientele effect, that you must make your dividend policy known in the market, then you must follow your dividend policy faithfully, so that you can act in the best interest of those shareholders who have bought your shares in the belief that you are going to follow this dividend policy. Yeah, constant dividends. Secondly, some companies will say, uh, we are going to have a policy of paying at least 30% of our profits as dividend. Then maybe some people want that. They say, okay, we'll take our chances with you. More profits, we'll get more dividend. Yeah, but at least we know we'll get at least 30% of that profits will be used to pay to us. 60% will be used to pay us. Yeah. Again, old accounting books used to suggest that companies, in order to grow at a steady rate, must reinvest half of their profit. Dividend cover must be 2 times. But nowadays the world is more complex than that. Yeah. Then some dividends are growth dividends, which means sometimes companies, they want to give higher dividends per share. Maybe first year they gave 45 cents per share, next year 50 cents per share, next year 60 cents per share, then 70 cents per share. As the company grows, maybe growth companies that are listed, they might want to do that. Then there could be dividends. Again, Modigliani and Miller theory. They are the two people you must remember. No, Franco Modigliani and Merton Miller. Ah, they're very important people in our life. Later, I will cut and paste and put one picture here for you so you can see them. Anyway, they have talked about the residual dividend theory. And they said that actually how much dividends a company should pay, if a company is going to have any policy at all, the best policy for the company to have is a residual dividend policy. And this actually makes sense, because what they are saying is, if you look at the amount of profits that you expected to generate during the year, based on the profits that you expected to generate, you can plan for your capital expenditure in the coming year. You see, every year you have your budget, you have your capital investment schedule. Yeah, not all the investment is going to be undertaken in one go. Maybe some in the first quarter, some in the third quarter, some in the final quarter, something like that. But uh, you can plan for your capital expenditure, uh, and based on the profits that you have, you plan your capital expenditure. Based on your growth of your market share, you plan your capital expenditure. And of course, the related working capital that is required. Working capital required, yeah, for the coming period. So what the firm will do is they will take profit after tax to provide for capital expenditure and working capital required in the coming period and pay dividends based on the residual amount available. Required, sorry, huh? I, So residual dividend is profit after tax minus capital expenditure minus working capital requirements. Yeah, simple example. Let's say net profit after tax uh, equals 50 million. Um, Capital expenditure next year 30M. Related working capital 5 million. So how much will be residual income, people? Talk to me. How much?
15.
15. Thank you very much. Everybody in the room okay with this? Yeah, 50 your profit after tax minus capital expenditure minus working capital. So that's all. That's called residual dividend. What are saying is you take care of your capital expenditure, you take care of your related working capital, then whatever is balance you pay. So then people say, what if your capital expenditure next year is more than 50 million, your profit is 50 million, then it is more than 50 million. Then Modiglani and Miller say, no problem. Just let the market know that you have to spend more money and you go and borrow. Let us say your capex next year is 60 million and you need working capital another 10 million, you need 70 million. So you go and borrow the 20 million and carry out your business activity and tell your shareholders that look guys, this year no dividend, and because it's a capital market that's in equilibrium and all investors are rational, they're going to say okay, all the best to you, directors, please go ahead, have fun. Yeah. uh, so they're based on assumptions like perfect capital market, rational investors who have similar expectations of the future, and they are in agreement with the directors. And more importantly, they said dividends convey no information to the market, meaning to say, if the company pays dividend, it is not seen as a good sign, and if the company does not pay dividend, it is not seen as a bad sign. Yeah, so dividends convey no information to the market. But of course, this is not true in real life because non-payment of dividend sometimes can create an impression of weakness, and people like to be paid dividends. Yeah. Fund managers and senior citizens actually rely on dividends. There are certain categories of people who actually rely on dividends. Other views that you may have to talk about when you are looking at this kind of questions are that, what about the position of high income individuals? Like in Malaysia, if you have gains made from sale of shares, there's no tax on it. We don't pay tax. Yeah, if I sell shares and I make a profit out of it, there's no uh, tax charge at all. But if I get paid dividends, then yes, there's a tax. Yeah, we called it frank tax dividend payments. Frank, that means tax at source. So maybe if I'm a high net worth individual, I say to the company, no need to pay dividend. Let my share price grow. And when my share price grows and I sell the shares, then I will be able to get a better price. Yeah. But then there's other alternative theory which says that there is a good number of investors, whether rich or poor or whether fund managers or otherwise, they like to have some dividends. That's called a bird in hand theory. Yeah. So bird in hand theory suggests that investors generally prefer dividends to capital gains. So if the examiner asks you, so what do you think? And then you can come down to a conclusion and say, well, taking all these things into account, listed companies should have a very clear dividend policy. That dividend policy must be communicated well to shareholders, and the company must have a consistent dividend policy and consistent payment pattern of dividends. We have found empirical evidence, yeah, market evidence shows that companies that have a constant dividend policy tend to do well in their share price. Yeah. So does dividend actually have an impact on share price? In theory, mathematically, Modigliani and Miller say no. In practice, yes. Yeah. Okay. That's dividend policy theory. Yeah. I hope you write 2 essays today at least, capital structure theory and dividend policy theory. Yeah. Okay, we are down to the home run already. The last key topic that or theory topic that I think we need to discuss, the shareholder value management. Okay, so these are definitions taken from Investopedia. Shareholder value added is a measure of the operating profit that a company has produced over and above their funding cost or cost of capital. The basic calculation is net operating profit after tax minus the cost of capital, which is based on the company's weighted average cost of capital. Now, in the 90s, a company called Stern and Stewart actually came up with a similar measurement. Instead of calling it shareholder value added, they called it economic value added, EVA, where you can see the formula is net operating profit after tax minus capital invested times WACC. Yeah. Only thing how you measure capital invested here might be very specific. They tried to actually claim ownership for this and said, anybody who want to use this, please pay royalty. But they didn't win the case. Yeah. So obviously, as you can see, this is just another way of presenting shareholder value added. Another phrase you need to know is market value added. Market value added means the difference between the total market value of the company shares, market capitalization, minus contributed capital. Now, this morning I used the term contributed capital. What is that? Contributed capital means total book value of equity plus book value of your bonds and debentures. That's the actual money that people have contributed. Now, we have contributed capital through bonds. We have contributed capital through equity plus retained earnings, everything. So let's say that's 500 million. But when we look at our company's share price, for all the shares that are listed on the stock market, we have 100 million shares at 6 ringgit. So our market cap is 600 million. Our contributed capital is 500 million, but our market value of shares is 600 million. So we'll say market value added is 100 million, 600 minus 500. So, okay, some maths here. Shareholder value, we said, is present value of cash flows per annum. Is now discounted at required rate of return. So if you have a sustainable future cash flow, say 10,000 per annum, and your required return on capital is 12%, then shareholder value will be 10,000 divided by 12%, give you 83,33333. Okay. So how does shareholder value added work? Well, let's take an example. BAC Berhad has reported the following results. Yeah, operating profit. Let me change the numbers to make it more exciting. 168,000, and let us say they paid tax for the year 28. 1, 2, 3. 28. That's still all long numbers, huh? So you get net profit, operating profit after tax was 196. Yeah, is your actual NOPAT. Now let us say the designated value of the capital invested is 1.5 million. Yeah, and the required return uh, on this is 10% based on the market. So the required operating returns would be 10%. K not lah, presumably. Okay, K not.
So sorry. Uh,
Yeah.
the the operating profit should minus tax for the year, right?
Yeah, correct.
For
Oh, didn't minus ah.
yeah,
Minta
you
maaf.
added.
Okay, sorry lah. Thank you. Ah, very nice.
Welcome.
So, yeah. Now net profit, operating profit after tax is actually 140,000, but the required uh, operating returns should be 150,000 based on no more 10% of this, based on 10% of how much? 1.5 million. Yeah, 1,500,000. Based on 10% of this, the company should make 150,000, but they made only 140,000. Now 140,000 is not a bad operating profit, not by any measure. Yeah, uh, but it is below the required net operating profit after tax. Yeah, these are your actual returns. We call this actual operating returns. These are your required operating returns. So in this case, shareholder value becomes negative, which means although they made profit, but did they add to shareholder value? No, because required returns were 10%. They did not achieve 10%. How much did they achieve? Yeah, how much did they achieve? They only achieved 140,000. So actual NOPAT, you can say, is equal to 140,000 divided by 1.5 million is equal to 140. 140,000 divided by 1.5 million. So 140 equals 140 divided by 1500 as a percentage. They only gave 9.33% to shareholders. Required return 10%. So there you are short. And that's the approach that EVA took, by the way. Yeah. When using EVA, if we were to express this, what we would get is actual net operating profit, which in our example now is 140,000 divided by 1,500,000, isn't it? Yeah, and that we have worked out is equal to 9.33%. Required returns are 10%. So do we have economic value added or economic value destroyed? Yeah, in this case, if this is 10, yeah, if this is 10, then you will get equal to 10 minus 9.33, giving you negative 9.33 minus 10, giving you negative 0.67. Yeah, so you say if this is negative, then economic value is destroyed. What they are saying is this money could have been used better in some other investment, because for this investment we required returns of 10%. Yeah, the cost of capital is 10%, which was not achieved. So if I took now negative 0.67 multiplied by 150, sorry, 1.5 million, 1500123, what did I get? Sorry, this percentage multiplied by 1.5 million, I would get, let me write it down. Yeah, that would be equal to negative 0.67 multiplied by 1, yeah, 0.5 million, giving us uh, negative, oh, because of 0.67%, that's why. Yeah, I understand. Yeah, I can use percent, 0.67% multiplied by 1500. Oh, no need to type again. Where is it? Where is the 1500? Here we go. 1.5 million. Negative 10050. Yeah, by right we should have earned uh, more. Our required net profit after tax is short by 10,050. Yeah, because there's a bit of rounding up here because I use 0.67. Yeah, unless I had taken this. So wait, then I will get exactly 10,000. Let me get this for you exactly. Equals this as a percentage, then you get now 10,000. Yeah, so you see that is what Eva was trying to show, or economic value. Eva is not a girl here. Eva is economic value added. If your actual net profit after tax was 140,000, even though you earned 140,000, under these models, we will say shareholder value has been destroyed. Why? Because based on the risk in your business, you're supposed to give 10% returns, which means you're supposed to give 10% of 1.5 million, which is 150,000. Your business results for this year at operating level after tax are only 140,000. Why do we take operating profit? Because that is what the managers, the business managers control. Yeah, so this is to measure business managers' efficiency. Why after tax? Because it's a reality of life. So we take operating profit after tax, and we forget about borrowing policy, dividend policy, gearing policy. That does not impact your operating results. And that's the beauty of these models, you know, because they are directly relevant to the operating results of the business. Therefore, they measure the operating efficiency of the uh, managers. Yeah. Any questions at all? All good, huh? Okay, so market value added, as I said, is simply if I take the book value of my equity, book value of my bonds, book value means balance sheet value from statement of financial position, I'll get total book value of contributed capital 178,000. Yeah. Um, Market price per share, let us say, is 5 ringgit, and total number of shares is 60 million. So total market value is 300 million. Now this is called market cap. If market cap is 300 and book value of your contributed capital is 178, therefore market value added is 122 million. Yeah, not difficult concepts. These are easy enough concepts, but if you know, you know. You don't know, you don't know. Yeah, that's why I thought this is important for us to talk about these key concepts in terms of value. Yeah, shareholder value. Now there is also one other things that was mentioned at the end of your syllabus, and that's about budgets. Uh, there are two broad categories of budgets you must understand. Two types of budgets that all companies have. Yeah, uh, those budgets that we do every year, we call them operating budgets, year to year, year in, year out. Yeah, of course, many companies don't do budget. They do wayang, they do drama. Yeah, we say, isn't it, our politicians do wayang and drama. But actually in companies also, when it comes to budgets, we all do wayang and drama. Yeah, sometimes better than the politicians. Yeah, because accounting department will say, give me your forecast, give me your budget for next year, and fill in the blanks into the Excel worksheet that I'm giving to you. Then many companies, sadly, they will just take whatever they have put in last year, tweak here a little bit, tweak here, there a little bit, this one 10% more, 5% less, da 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 da, that's it, budget done, thank you very much. Yeah, uh, that's not budgeting, that's not financial planning. Yeah, so for me as a consultant to companies who prepare budgets, uh, I would not tolerate that. Yeah, and I have become a mother-in-law to some of my clients, and then I tell them this is how you do a budget, and I show them a 5-part budget approach. So budget becomes like a big book. That should be the budget. Now, of course, no more big book because of COVID and all that. So now it becomes actually a document on a shared folder. Yeah, a good thick document, editable document which people can contribute to. So there are a lot of good ways to do budgeting. Sometimes this online thing is a good thing. It actually helps you, yeah, to become more efficient. Anyway, the annual budgets are called operating budgets. Yeah, for example, your sales budget, departmental budget, overhead budget. And then the other type of budget is called feasibility budget. Yeah, that means should we do or should we not do. Normally feasibility budgets apply to big capital projects only. If you want to go and buy a car for your managing director, you don't do a feasibility lah. You want to buy 5 laptops, no need to do feasibility. But if you're going to set up a factory, buy a plant, uh, change the facade of your factory or something like that, and get a new showroom where you think you're going to uh, invite more people to come in and entertain them, and that's going to increase your revenue. Big things like that. Buy over another business, competitor's business, that sort of thing. Yeah, move into a new market. All of these things require capital expenditure, long-term expenditure, and they require a feasibility analysis. Please remember, feasibility analysis, this is done after the company has completed the strategic and operating feasibility. So first you see matching to your strategy, good. Do we have the capacity to do this? Good. Yes, green light in both places. Then we say, are we making money or not? Yeah, then we do feasibility of finance. Now, operating budgets, since it's in your syllabus, they may ask you what type of budgets do you have? What kind of financial planning does the company do? How is the financial reporting of budgets different from the reporting that you have in your published accounts? Yeah, because at the end of the day, that's what this paper is all about or supposed to be. Then you can talk about different type of budgets. Yeah, fixed budgets are all the targets fixed by department or by product or by location. Fixed budgets. Yeah, so sometimes we have regional office fix the budget for us, so we have to follow regional office of a multinational company. Yeah, we just follow. Yeah, we can go for budget meeting. We go for budget explaining to us how to get the targets going. That's all. Then we have flexi budgets. Flexi budgets means the targets can be varied based on changing market conditions. Yeah, like now, many of them have moved to not only flexi budget but also rolling budget. That means we are doing quarter to quarter, no more year to year. Cannot do year to year. Too much uncertainty here now. Yeah. So many companies who still want to survive, uh, in any kind of crisis or any development or any phenomena, you'll get two type of companies, two type of people, two type of organization. There are those people who will sit down and tear out their hair and say, well, there's nothing I can do. Look at COVID. I'm a victim. I'm suffering. Now what to do? I really have no clue what to do. Yeah, that's one group. The other group is they say, okay, now there's COVID, uncertain, uncertain for us, uncertain for everybody. What do we know? What can we do? What can we plan? What can we change? uh, how can we adapt to the new normal? Then those kinds of companies, for them, flexi budgets will work very well. For them, the quarterly budgets will work very well. Why? Because they're willing to change. Yeah. And whether anybody likes it or not, this year, everybody got to change. Yeah. Okay, then some budgets, this we call this zero-based budget, actually started in the 80s already. Some people used to say that in many companies, this happens to large companies and public corporations, that means government corporation like our GLCs and all that. Certain budgets are approved by default because last year we had this, so this year also we must approve so much. But zero-based budget asks why? Why do you keep need approving the same budget? Why don't you think about what if you were a new startup? Did you need this? Can you be lean? Can you do without this? What if the firm does not have this at all? So that's zero base. You go on zero base. Then someone says, no, no, no. Maybe we don't need 100,000 budget for this, but we need at least 50,000. And you say, are you sure 50,000? Can't you do it 20,000? Actually, 20,000 can, but 50,000, we are used to 50,000. Can, but it's difficult. Then you put 20,000 or you put 15. Yeah, let them work harder. Yeah, I tell you, very interesting. Budget discussions are very interesting. It's a horse deal, really. Yeah. And then we have activity-based budgeting, because they have mentioned this, so now I have to talk about it a bit. These are based on the collective cost of specific activities within the business. Actually, they don't follow the typical cost classification. Now, I have just put in an example here. For example, if a business has two products A and B, how do you allocate the cost based on which product uses more resource in each area? So, for example, if you have raw material consumption, rental for space use, cost for labor, general overheads, you see the way you classify your costs a bit different. Yeah, so then you ask yourself, is it equal between two products A and B? Typically what companies would do is, okay lah, these are what we call our general overheads. Yeah, uh, some are variable, some are fixed. Like rental might be fixed, general overheads might be fixed, raw material consumption and cost of labor is variable. So we put everything in and we ask ourselves, okay, raw material consumption, how many percent of the cost is attributed to this product A? How many percent is attributed to product B? Rental space, uh, we might say, oh, use equally. But in this system, we say, no, A takes up more space, so give 70% of the cost to product A. A must carry 70% of the cost. Why? Because it uses more place. Yeah, labor, of course, again based on usage, and then general overheads, of course, if it's using more place, obviously the overheads would also be more for A. So we allocate our costs based on multiple bases, not just on your uh, sales value or your head count or something arbitrary like that. Specifically for what are the activities that were used to create each product or each service. Yeah. So now when we take all these costs, we call this a cost pool. These are called the cost drivers. Yeah. These one are cost drivers. Cost drivers. We put the cost drivers down and then we work out the cost pool. I have just talked about this in 3 minutes to you. In real life, this really takes work. That's why many companies don't like to do this. But this is cutting edge financial reporting. Yeah. Uh, Once you have got your cost pool, say we know total consumption cost for 45,000, from which 40% only was the cost of materials used by A, 60% by B. This is normally easy to do because it's variable. But when it comes to fixed costs, you need to look at space used and things like that. So 120,000 rental, broken up 70% to A, 30% to B. 200,000 cost for our manpower or human capital cost. 65% of the salaries for A, only 30% for B. That again easy to identify. General overheads, again based on where most of the supervision, the management resources are used, the utilities are used, common overheads are used. Yeah, HR might be more involved with these people. IT might be involved more with these people. Security might be involved more with these people. So general overhead 60% here, 40% here. And when we know how to allocate this and we allocate it according to these percentages, then this is the cost we get. And we get a nice allocation system that our total cost pool of 395,000, from here 250,000 goes to A, 135,000 goes to B. But when we do this, we know why we did it. We have got specific reasons, 4 different justifications for doing it, rather than saying all half or something like that. Yeah. So this is a bit of budgeting. I mean, budgeting is something you can talk about the whole day. Now, when I was doing the syllabus review, I found that your examiner had mentioned this fellow, Meek and Saudagaran. Basically, this relates to um how to, yeah, this is discussion related to issues of uh, bringing together reporting, bringing together reporting uh, frameworks. So generally the syllabus talks about it, isn't it? What about IFRS and MFRS and things like that? Now, because they mentioned this in the syllabus guidelines, so when I went and looked at it, basically what Saudagaran has done is, Saudagaran and Diga, first in 1990 he wrote this, and then in year 2000, yeah, he upgraded this thing. So he said, we need to harmonize our reporting for ASEAN. If ASEAN is supposed to work, we need to harmonize this. And then many of the companies, many of the countries within ASEAN, well, there were working committees, they started working on it. This is 1990, yeah. This is 10 years later, year 2000. Did they succeed? No. Why? See, this is his later article, Saudagaran and Diga. Why? Because they found that Indonesia and Thailand are more influenced by GARPs. GARPs are rules-based accounting standards. Generally accepted accounting principles are more actively used in Indonesia and Thailand, whereas Philippines, Malaysia, and Singapore, we use what we call uh, principle-based accounting standard. We use IFRS. Yeah, so this is IFRS. We use IFRS. These guys use GARPs. Yeah, and so he found that there was still at year 2000 still an issue. So is it easy to bring congruence? Is it easy to actually bring together the different reporting standards? Not easy, but desirable. Yeah. So maybe you might want to write a short essay on this. So I've just taken some extracts from what this guy wrote. Yeah, for your reading pleasure. Now, like I said this morning, we have probably covered about 80 to 85% of your syllabus topics here, and that should be enough for you to comfortably pass this examination. Yeah. Uh, but what you need to do is to work through all these Excel worksheets that I have. I will share on the WhatsApp group this updated ones. And also, I think I will be able to share the video links with you later today. Uh, and work through the theory, work through my worked out examples. And if by mistake I have typed in a wrong number or something, just trigger me and ask me, hey, why did you get this number? And I'll try to explain. Yeah. So with that, I would like to wish you all the very best. Are there any questions? Any questions at all?
So,
Yeah.
how short is a short essay?
How short is short, huh?
Yeah, I mean because last time when I sit for the exam, actually examiners are very